based on that alone. That's good. All right. So, how do our clients who are already doing some business in the US turn around and do business in Kenya and then combine those businesses for tax benefits and increased profits? All right, so we are going to do a high level overview. Some of the things that we discussed, we're going to essentially do some case studies on existing clients, right? So your situation, sorry, I think that's Facebook trying to get that phone set up properly. So your situation may not match their situation, right? So there are local rules. The United States is ridiculous in this because that all 50 states are actually countries, right? So if you go back and you look at how the U.S. was formed, it's actually 50 countries that are cooperating in a union, and then they created a constitution and an agreement to operate together, right? So that's why the laws from state to state to state are different. Okay, in Kenya here we have counties. We have almost as many counties as America has states, but all the counties follow the same law, right? Because they're not 48 different countries operating in a union. It's one country and 48 counties, right? So that's the reason why, in a nutshell, why all of the states have sometimes completely different rules. And so you always want to make sure that you have a professional from your state if you're a U.S. citizen. So there's that, right? Because there are state tax rules, and we're not going to talk about those today because we would have to have 50 different conversations. So, what ends up happening with most of our clients is they utilize on their U.S. side a U.S. company. So let me give you a solid example of like how that goes, right? We'll have a client that wants to do short-term rentals here in Kenya. They have experience doing short-term rentals in the United States. Short-term rentals are sometimes referred to as Airbnb, right? But any kind of short-term or even sometimes mid-term, rentals. And so they already have a business in the US that's typically doing okay. Now, typically, when you're doing rentals, you don't want your rentals in a corporation, typically, right? There are tax reasons for that. But typically, an LLC works really, really well for rentals, okay? That sometimes poses a problem, though, when you go internationally, right? Because one of the things that you're looking for is you're looking to be able to use your your dividends received deduction, right? Now, there's two of them. There's actually a local dividends received deduction, so you actually don't have to go international to utilize a dividends received deduction. Hey, Jacob. Hey, Lisa. But there's a foreign dividend received reduction, right? Or deduction, I'm sorry, right? And so what does that mean? That means that if your company receives dividends from another company that it owns a piece of, and it doesn't have to own like 51% of, just has to own like 10%, right? So if your original company owns 10% of another company and it receives dividends, it's possible that those dividends would be tax exempt. Here's the issue. That only applies to C corps, and C corps are typically not the best structure to do rentals. So what ends up happening is the client typically will create a C corp holding company, right? If you look up Google, right, you know how you can look up company structures and all that. So if you look up Google, Google is actually Google LLC. The parent company is Alphabet C Corp, right? So local companies can do this as well. And it actually, there's a holding period where you have to hold those dividends in order to get the tax benefit. And so the holding period is actually not that bad. I think for local companies, it's like 60 days. For foreign companies, it's like a year. So be aware, right? So your timing is something that you want to talk to like your tax professional about and get your timing set up, because maybe you hit yourself with a massive shot of dividends every 1st of January so that you meet the holding requirements by the next tax season, because you don't want to do it in November. You wouldn't have held it long enough to be able to get the deduction. Why does it matter? It matters because the deduction is 100%. That's why it matters. Right? So, if the C corp owns 10% or more of the foreign company, right, then the dividend deduction is often 100% tax free when it's brought back to the U.S. All right, that's just the law, right? So go look it up. Right? So foreign dividends received deduction, right? FDRD. Oh, no problem. Go ahead to bed, Lisa. Thanks for hanging out. Right. So that's typically part of the strategy for most of our clients to be able to have their company over here send that money back to themselves in the United States and get that 100% tax-free, dividend deduction. Now, why would they do that? They do that because if you guys watch any movies and they're talking about the Cayman Islands and Swiss bank accounts and all the BS that doesn't exist since 1984, right? But it makes good, cinema. Then in those movies where the people are hiding the millions offshore and the blah, 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 they're doing it so that they don't get taxed. They haven't repatriated the funds. And since the funds haven't been repatriated, they're not taxed in the United States, right? They're maybe taxed wherever. Yesterday, we were talking about Seychelles and how they have a 0% tax rate, right? So you leave the money there, you don't pay the tax, da, 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 da. Well, the government's not dumb. They realize that this is a bad deal for them and it's a problem for them. So they created a mechanism by which you can bring the money back, put it in U.S. banks, spend it in the U.S. economy, so on and so forth, and not necessarily have to worry about taxes, right? But you're operating in two different jurisdictions. So the other side of that is, okay, what about the taxes in the place where I made the money, right? So we always are strategic in the places that we choose, right? If you've been following me for a while now, we don't choose nothing based on no vibes. We don't choose nothing because we think it's cool. We only choose places that are strategically sound, right? So one of the reasons why we choose Kenya is because they have complementary systems, right? They have complementary systems. So in Kenya, they have something called a investment deduction. An investment deduction, and on the Kenyan tax side, allows you to deduct up to 150% of your investment, right? So now you're getting 150% tax free on the Kenyan side, and you're getting 100% of the dividends that you send back to the US side tax free as well. See how that works? Right? So we're not like, oh, Ghana is so cool. We love the vibe. So we're going to Ghana. No, then we pay taxes. Right? So it's always strategic, right? Everything you want to do around the businesses that you're trying to create needs to be strategic, not vibes, right? So we pick strategic countries, we pick strategic corporate formations, and we make sure that we get the biggest bang out of our buck, right? That's why we do so much better. That's why when you see my clients and you see the businesses that we're working with, they seem to be doing so much better than the ones in Nigeria. They seem to be doing so much better than the ones in Ghana because they get to keep so much more of their money for so much longer, right? Because they're making a strategic decision, not an emotional decision. Super, super important to make sure that you got that going on, right? So the other thing is, you'll see a lot of people, they'll come to Kenya. Okay, great. You made a strategic decision, but they're all in Nairobi. In Nairobi, you only get 100% tax deduction on your investment because you're in the major city. According to the KRA, you only get the 150% outside of the city, which is why all of our clients are here at the beach, right? And get a better lifestyle, less crime, you're not in a busy city, and you pay less taxes, right? Because the government has it set up that if you're in the city, your deduction is smaller than if you're outside of the city, right? So by being outside of the city, those clients of ours get 150% tax deduction on their investment. And it used to be they didn't pay taxes at all until their investment was paid back. And you can reinvest in your company at any point in time. You want a new roof for the building you're using for your company? That's reinvestment, right? You want to add on, you want to build on to your Airbnb, that's investment. So it used to be that as long as we kept investing, we never had to pay taxes. They have capped that to 5 years now, right? Where is this? So we're discussing U.S. clients of ours who have businesses in Kenya, and how the U.S. tax code allows them to bring money back from those businesses tax exempt, how that works, and how the Kenyan tax code allows them to be tax exempt while they're here, which allows them to make a shit ton of money, Juliana. All right. So again, in the US, you got all these 50 states with all these 50 rules. Some of them will have some state rules that may or may not jam you up. So definitely being formed in the proper state matters as well. The cool thing is once you leave the United States, you can pick any state you want to form your corporation, is because you don't have a presence in the United States anymore, right? So you can choose any state you want to form your umbrella C corp, if that's what you're going to do, and operate from there, right? So all your original LLCs in this particular example, where it's a short-term rental business, and they have these LLCs that own the rental properties and those LLCs are typically in the state where the property is. That typically makes the most sense. But the C corp that owns them all, you can pick the state that makes the most sense for you, and go from there. Now, remember, I said that there is your dividends received deduction. So that's for your domestic stuff. So even their domestic LLCs that own their short-term rentals, they could still use a dividends received deduction on the money coming up from those domestic LLCs. But that's something that, again, you want to work out with your local person. Okay, you want to make sure that your local CPA, your tax strategist, we use enrolled agents, right? And our clients get to use enrolled agents on this side. So on this side in Kenya, we have certified enrolled agents for the IRS that are here in Kenya, that will take care of your tax strategy for your business here in Kenya. What up, Eddie boy? How's it going? And our guy on this side, our enrolled agent that we use on this side, is pretty awesome. He was actually a comptroller for the government for years. So he did taxes for government agencies, or tax compliance for government agencies. And then he left. He actually left the government when Trump offered the early retirement to everybody. He took that package, and that's actually how he financed his relocation to Kenya. So he financed his relocation to Kenya with with Trump's nonsense early in his presidency, and so now he's able to directly work with our clients versus remotely doing it. So that was awesome. So always an opportunity, and all the nonsense, there's always an opportunity if you look hard enough for it. All right, so now there are trade-offs, of course, right? There's a reason why typically when you're just doing your short-term rental business or your real estate business, period, you typically use LLCs for that, right? So there are trade-offs when you're setting this stuff up, which is also why you got to speak to a local person. You don't want to speak to a general person who maybe knows federal tax law and is not familiar with your state's tax law. So you want to speak to your local person, because typically all your money, the tax-free foreign dividends and the domestic LLC income is now landing in your C corp. Is typically how that's going to work, right? So for some people, it makes sense for them to pay themselves a salary from the C corp, like a W-2 salary, and that can kind of zero out their corporate tax liability. So those numbers have to be right because a corporate tax liability is typically 21%, right? It's typically a flat liability. So if your W-2 liability is going to be more than 21%, then maybe that doesn't make sense, right? So again, that's a conversation that you have to have because you're going to have a state liability possibly on that paycheck as well, right? So what you see often is if folks are running that entire organization from here, like if they've relocated and they're running their businesses, but they're running it from here, and they want to get rid of their state, not their tax liability in their state, but their state residency, so to speak. The word is eluding me this morning, but their tax residency, right? So their state tax residency, if they want to get rid of that, or if they want one that doesn't matter, then they'll pick a state with no income tax, right? So they'll pick a state like I believe like Alaska has no income tax. I think Delaware is one of those as well. So they can pick their address in the United States if they're no longer living there. And they can pick kind of their state tax residency at that point if they're no longer living there at all, right? So sometimes there's some things that go into that. Like if you want to build a really strong case for that, sometimes, you know, you want to go ahead and get an address before you leave. You want to go to that DMV and change over your driver's license before you leave, that type of thing. So you can be like, all right, I got an Alaskan driver's license. I have an Alaskan address, which doesn't mean you have to go buy a house or rent an apartment. You can go to the U.S. Postal Service and get a street address that puts mail in a P.O. box, right? But you can establish your tax residency in the state that you wish to establish it in if you're not living in another state, right? Because the issue becomes like when you play this game and you're still living in the United States, the issue isn't that you establish tax residency somewhere else. The issue is that you might be committing like a tax evasion on the state level if you live in another state, right? So if you live in Pennsylvania, but you're like, oh, Delaware has no income tax, so I'm going to establish Delaware tax residency, but you really live in Pennsylvania. So now you're not paying taxes to Pennsylvania, but you are paying taxes to Delaware. That's the issue. But if you've left the country and you do not have a tax residency to Pennsylvania and you establish a tax residency in Delaware, there's no issue, right? Because you're not cheating some other state out of their taxes, right? So for the folks that relocate out here, they can choose what their tax residency in the United States as a state is concerned, to ensure that they don't run into, you know, any nonsense as far as taxation on a state level. And then for them, it might make sense to do a bit of a salary hack and pull a W-2 salary from the C Corp in order to kind of get that money out and reduce the tax liability in the C Corp, possibly even zero it out, right? And so it would avoid like a second layer of tax on retained profits, right? Because there might be a second layer of tax on retained profits if you don't zero it out with the W-2. So all of that is going to be handled by your tax strategist on the U.S. side. And if you're working with us, then we have an enrolled agent here in Kenya. So your tax strategist, even though they're the U.S. side tax strategist, they're here in country for you, and you can like physically talk to them and meet them and blah 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 blah, right? Then on your Kenyan side, as we talked about earlier, you can deduct up to 150% if you position yourself properly, right? There are some people that just push Nairobi, and then they lose a third of their deduction, because in Nairobi you only get 100%. Outside Nairobi you get 150%. And not just Nairobi, I shouldn't even say that. It's major cities. So it could apply if you choose like Mombasa. Definitely applies if you choose Nairobi. But it doesn't apply, to us, because we're in Diani Beach, I have other clients that are in Key C, doesn't apply to them. Key C is like rural, it's like the countryside. I have clients that went to Malindi, doesn't apply to them, right? So there's strategy in the choices. Okay. You can't be taking a surface look at things. There's strategy in the choices. Now, there are also what are called EPZs. That's a little bit more specific. You're not doing like real estate business in an EPZ. An EPZ is an export zone. And in an export zone, things are typically tax free, right? So there's that. Now, C corp structures, again, on the pros and cons side, excuse me, C corp structures require additional paperwork, right? So there's like, oh man, IRS form 5471. Don't quote me on that. It's early in the morning here. But you got to be compliant with that. And then there's like your F bar and all this other stuff that you got to be compliant with. Now the F bar and all that stuff you would have to be compliant with anyway. But the C corp 5471 is going to be a new corporate IRS form that you're going to have to be compliant with, but your tax person deals with that. Like you shouldn't be doing any of that if you're at the level that you can now expand internationally. So while it's a con that might need to be discussed because it makes your tax return more complicated, which may make it more expensive, it kind of doesn't matter. If you're doing business, then the business should be paying for that anyway. So people who are overly concerned about that, I've found tend to be people who have like only businesses on paper, like they don't have real businesses, right? So you want to look at the income level and focus on avoiding domestic double taxation, right? Because the LLC that's kicking up into the C corp might create a domestic double taxation system, or a situation rather. And then you want to make sure that you're securing the 100% foreign tax exemption, right? Now your FTC is normally wiped out, so you typically can't do the foreign tax credit if you're doing the dividends, right? So if you're doing the foreign dividends received deduction, then you typically can't do the foreign tax credit. So which doesn't matter because you're getting 100%. You don't get 100% on the FTC. So you're doing better with the dividends. You're going to have to figure out from your local guy what is a reasonable compensation. That's going to change for each person. And then you'll want to take a look at what the increase is on your annual tax filings, right? Because the complication of it might create, more complexity and, more costs in the filings. Typically that doesn't matter. I've never met anybody who like had a business that was making money. It was like, oh, it costs too much to file my taxes. Right. Typically that's not a problem. Right. All right. Any questions on that? Any questions on how our clients are typically keeping way more money than their counterparts because they're being strategic, or we're being strategic for them? Hey, Bella. Oh, hey, Bella. It's that Bella. Nice to see you. You are correct. You are correct. You have not seen or received any of those strategies from us because you're not actually our client. You came through an agent. So we stopped doing that. So you can definitely talk to your agent about getting a release and coming directly to us. But when it comes to agents, the agents provide all the strategy, not us. If you were directly our client, then we would provide strategy and all that stuff with you. But we used to do the agent thing where the agent was our client and was maybe representing your interest, but you weren't our client, the agent was, which is how you came to us. So yes, we've never had this discussion because you're not our client. But talk to your agent. We did get rid of that Talk to your agent. She does have to release you because of your agent agreement. But there's no reason for her not to, because she can't make like additional like money off of you. You're not like taking any money out of her pocket or anything like that, because she still gets the agent fee as a referral fee. So we didn't like cut them out for money reasons. We cut them out for exactly what you just brought up. We cut them out because people that came through the agents were failing because the agents weren't as knowledgeable as us, and the agents are not on the ground. So the agents are making really dumb decisions, thinking that they're smart decisions because they're not on the ground. So we got rid of the agents. So yeah, just talk to her. I'm sure she'll just go ahead and give you the release, because she'll still make an agent's fee. She'll still make the same amount of money and doesn't have to do any work. She doesn't have to talk to you anymore, and she'll still make the same amount of money. So yeah, just let her know. And then because we have non-circumvention agreements, so we don't circumvent our partners. So let her know. She'll sign the release, and then you can come and work directly with us. No, it shouldn't get more expensive. It might get cheaper. Sometimes agents used to like tack their own fees on top. So you might, like we don't know their business, so we don't know what they tack on top. But you might see that it's like 15 or 20% cheaper because you're not paying their fee. We haven't had anybody say it was more expensive. Everybody who's converted has said it's cheaper. Yeah, being yelled at. We don't say cheaper. It's more cost effective. This is why you need your team. Team keeps you. I'm sorry. Oh man. But yeah, nobody has said that it's more expensive. Everybody has said it's more cost effective. All right. Right. The 3 minutes that my social media manager was walking through that office, she caught that. Uh, but yeah, all right. So any questions on how we don't right Eddie, right? Any questions on how our clients keep more money in their pocket and we don't pay taxes? We don't pay taxes legally. Now, there are other taxes that you can't get away from, sales tax being one of them. Here it's called VAT. I like VAT a hell of a lot better, actually. VAT is essentially sales tax, but VAT takes the place of income tax. Typically, like it should. Some places have both, unfortunately, but it should take the place of income tax, which is nice because it's essentially a consumption tax, right? So, income tax, you go to work and they tax you for the privilege of breaking your ass at a job for somebody, right? Whereas VAT, they tax you when you buy something, right? So with the VAT system, we could both go to work. And then if I take my ass home and not go buy Gucci, I keep my money. If I'm an idiot and I go buy Louis Vuitton, I pay tax. It makes sense, So if I'm financially literate, I'm rewarded, and if I'm financially illiterate, then I pay taxes. So, and it kind of answers, all of the criticisms, even like the tax the rich people. Okay, cool, because when they buy the yacht, they pay VAT. Like they're gonna pay a tax on that you're not gonna pay because you ain't buy no yacht. So it immediately does tax the rich, but not in some weird way where like you're just sticking them up and pulling money out of their pocket for when they've done literally nothing, but be successful financially. So it's actually a really solid system, in my opinion. I like it. Plenty of countries have it. The United States is not one of them. But value added tax is what VAT stands for. And so whatever you buy, you pay a tax on, and it's typically a flat tax, and it typically doesn't apply to uncooked food and medicine, and like medical, like the stuff that you need. It typically doesn't apply to. So it's a pretty nice system. But those things are going to apply, right? your sales tax, your VAT tax. There might be a consumption tax, depending on the country you're in and all that, or what product it is that you're utilizing. So those, like, what we would consider almost like local taxes are still going to apply, but the big boy taxes are the ones that we're avoiding, right? So your corporate tax rates of like 30%, and 21% in the U.S. and 30% in Kenya and all of that stuff. That's the stuff that you want to get rid of. Those big giant taxes. Right? And those are just legal pathways to doing that, right? There aren't a bunch of giant steps, to doing that. They're just legal pathways. They're actually incentives for investors on one side, and on the other side, they're incentives to repatriate profits, right? So on the U.S. side, it's an incentive to repatriate profits instead of keeping your profits overseas. And then on the Kenyan side, it's an incentive to attract investment, which both of those things would apply to our clients. Why would I care about foreign dividend received deduction if I'm leaving the U.S. and don't intend to come back? Ooh, that's a good question. Good question. Because we talk about that all the time, right? Okay, cool. Happy you brought that up. So the U.S. still has like killer interest rates on loans, right? Globally, and this has nothing to do with Kenya, right? Globally, their interest rates are normally amazing. I think the only country I've been to that has better interest rates is maybe China, and you have to be Chinese to get them. Like, this can't be a foreign. So, when you're creating your international business empire, let's say, right, it makes more sense if you can. Not everybody like qualifies, right? But it makes more sense if you can to tap financing from the U.S., right? That makes more sense for a couple reasons. Number one, the interest rate's probably better, right? That's number one. Number two, you have bankruptcy protection. You have two forms of bankruptcy protection, right? Like Donald Trump is associated with 6 bankruptcies via Chapter 11. That's a corporate bankruptcy. Donald Trump, there's no record of him ever having a personal bankruptcy. All 6 of those bankruptcies were corporate bankruptcies, right? So you have both bankruptcy protections if things go left, right? So you also, as a U.S. citizen, you're taxed internationally. Okay, so U.S. citizens are taxed on their global income because they have a U.S. Passport. Okay, that doesn't mean that you have to pay taxes. It just means that you're taxed globally. Okay, there is a foreign earned income exclusion that can exclude up to $160,000 of taxes that are earned internationally, right? But you still have to file the tax return. Okay. So the reason why, even if you don't intend to go back, that you might utilize this structure is because you may be paying on a U.S. loan that funds the lifestyle anywhere you are in the world, right? In this case, it's Kenya. But anywhere you are in the world, you might have a U.S. business loan that's handling that, because remember, in order for you to qualify, your U.S. business has to own at least 10% of the foreign business. Now, for the loans, sometimes they'll say 25%. But as long as you're above 10%, you're good as far as your foreign dividend, right? So that's why that strategy makes sense, because you may be paying down some sort of debt that's in the United States at a lower interest rate than you could have been paying, here in Kenya or anywhere in the world virtually, right? And then if something goes wrong, if if you get hurt, there's an illness, there's a whatever, and you need to now consolidate and liquidate, and you stop paying that bill, you have bankruptcy. Versus in a lot of countries, there is no bankruptcy protection, right? So typically, our clients will get all their funding from the United States, or they'll try to, right? Sometimes it depends on how much planning is going into it, how many years of planning is going into it, right? Because they may need to build business credit on the US side, which typically takes 2 years. Sometimes they need to increase their own credit, which we got to send them to a specialist, to do that, if they have enough years in advance. I got a client named Pascal who's really good with the planning, right? So he's planned out 7 years in advance to do this. So by bringing those dividends back to the U.S., you can get that 100%, tax deduction on the U.S. side for the dividends. And then if you're working with our people in Kenya, then you will get possibly the 150% tax exemption on the Kenyan side. So that throws more money into your pocket. You got to be working with people who know what they're talking about, though. You got to have a solid team that can do that. So yeah, Veltrix, I am happy that you asked that question, Veltrix. But the reason we've never spoken to you about it is because you came through an agent, so you're technically not our client, okay, Veltrix? But just go talk to her. She can release you, and you can become our client, and then we can do all that tax stuff with you. But yeah, we have a certified enrolled agent here in Kenya who's a U.S. certified enrolled agent. Only enrolled agents can represent you to the IRS. So he's a certified enrolled agent. He lives here in Kenya, so you can meet with him in person. He's in Nairobi. I know you're in Malindi, Veltrix. But just call her. But we stopped all agent stuff like a month ago, right? So agents are now just referrals. They just refer us clients. It's not, before it used to be you were her client, and then you had to deal with her, and then we were like her vendor, right? So we couldn't just tell you like strategy. She was in charge of your strategy. We don't do that anymore. So just let us know. We used to have 3 agents, right? So if you guys are wondering if you came in through an agent, we have 1 agent from Florida. We have 1 agent from Ireland. And then we had 1 agent from New Jersey. So if you're operating, in those 3, through one of those 3 folks, and you're wondering like, why haven't I ever heard of how to do the taxes? It's because we can't overstep that agent relationship and give you direct strategy. You have to get your strategy from your agent, all right? But we're taking no agents anymore, no longer any agents. So everybody comes directly through us. And if you want to onboard directly with us, it typically doesn't change the agent's pocket as far as our things are concerned, but the agent might have you on some kind of plan where you pay for whatever, I don't know. We don't really check their pockets like that, but there might be something you're paying for with them, which you can continue to pay for with them if you want, but you just have to be released to become like our direct client. All right. And I hope everything is going well with you. I haven't heard from your agent in a while, and we don't really get updates on your status because we're just a vendor, essentially, in that regard. So sometimes we don't even know what to tell you because we don't know what your plan is. Like, we don't know how you intend to make money. We don't know what systems you're using. We don't know what your, what your U.S. Situation looks like, because we're just a vendor if you came to us through an agent, right? So all the things your agent knows about you, or all the conversations you have, and like your weekly or your monthly meetings and all of that, we don't know any of that stuff. So it's really hard for us to even give you good advice because we don't know your situation. So we just realized that like that sucks for you, essentially. You know what I mean? And so we just got rid of that entirely. Because a lot of times what ends up happening is, and this happens specifically, your agent is the one from Ireland, and this happens specifically with her, and actually a couple other agents have done this as well. But what happens is none of the agents are here. None of the agents have relocated here, right? So they end up making decisions for you here that don't necessarily line up. So what ends up happening is like, how exactly did your agent vet your property manager? I know you had a problem with her because, yeah, I know, like the law firm, we know that you know, came after her, and all of that stuff. So I won't get too deep into your business on live. But how did your property agent vet that manager? We didn't provide that manager, right? So, but how could they possibly have vetted that manager from Ireland, right? So that becomes the issue. Is like, you know, your manager stole from you. You know, our lawyers are handling it for you, and we're tracking her down, but why did that even happen, right? Because they're not on the ground. So we just said, you know what, forget it. We're done with that. We're done with, you know, people making the best decision that they can make, but it's actually a bad decision because they're not here, right? And so in the future there will be nothing like that. But we do still need you to go back to Sandra and get and get the release so that we're not circumventing her. But other than if you have some like monthly agreement with her or something like that, which you can maintain actually, but other than that, it shouldn't affect her pocket because she still gets the referral fee for anything that you know might do. So she should give it to you. I don't see why she wouldn't. Let us know if there's an issue there. All right. Yeah, no, thanks for stopping by. I see you're a what is that? You're on the YouTube side? Is that YouTube? Looks like you're on the YouTube side. Thanks for stopping by. All right. Anything from Facebook or TikTok? Anything going on here on TikTok? Facebook? Anything? All right. So, yeah, that is typically how we do it. We always want you to talk to your CPA first. Okay, we always want you to talk to your CPA because there are local taxes that you need to get worked out, especially for those clients who aren't moving here. You have a tax domicile in a state. Right? So you live in some state somewhere. If you're, you know, if you're a U.S. citizen and you haven't left, and you have a tax domicile in that state, and so you need to figure out what that state situation is going to look like. All right. Did you discuss the proposal for banning dual citizenship? I'm just joining. It doesn't really matter. It doesn't really matter. We can talk about it, but it doesn't really matter, and here's why. If you already have your dual citizenship, then nothing is going to change because as a U.S. because this proposal is a U.S. proposal for the rest of you guys watching, and you're wondering, you know, what's being talked about. This is not a Kenyan proposal. So on the Kenyan side, this is not what's happening. But on the U.S. side, you cannot be denaturalized for that, right? So if you already have your citizenship, and then you know, and you have another citizenship, then you should be fine. What we see is it used to be, for example, Germany did not allow dual citizenship. They do now, right? Don't jump in the comments. I know they've changed their law, but they used to not allow dual citizenship, right? And so what would happen though is even in those countries that don't allow dual citizenship, when you're born, you have dual citizenship anyway, right? And then when you're 18, you're supposed to choose. Okay. So typically what happens is, and a really, really, really good example of this is China, right? China does not have dual citizenship, but it does not require you to renounce. So what does that mean? It means functionally when you're in China, you're Chinese. Doesn't matter how many other passports you got. If you have a Chinese passport, when you're in China, you're Chinese, period, right? And that's what would happen. So if the U.S. decided to implement that, it would be when you're in America, you're American, period. You're not calling any other embassies. You're not getting any special treatment. You know, something happens, you're not able to like run to them and ask for relief. When you're here, you're American, period. And when you're not here, you know, maybe you're not, right? Like I said before, Americans get taxed for having a passport. So in that regard, you're American, right? But when you're in Italy, you don't have to let the Italians know, you know, that you're American, you know, if you don't, you know, want to. I've never seen a country that has a law that forces you to disclose under which nationality you're operating, right? So it typically happens at immigration, and it typically happens when you check in, right? You check in as whichever nationality you wish to check in as, right? And then once you check in as that nationality, you've essentially made a declaration. Typically, the rule is, If you have the passport of that country, you must check in with that passport anyway, right? So if you're a dual citizen, for example, my son's a multiple dual citizen. When my son, when we just came back from China. When we flew into China, my son checked into China as a U.S. citizen, right? Because him at 19 months old has a 10-year multi-entry visa to China, right? So I guess he inherited my status. I don't know how they did that or why, but he has it. So when he goes to China, he checked in as a U.S. citizen. When he left China, he checked out as a U.S. citizen with immigration, but checked in with the airline as a Kenyan citizen with his Kenyan passport, right? Why? Because if he was a U.S. citizen, he would need a permit or a visa to come to Kenya, right? So because he has a Kenyan passport, when he checked into Kenya, he had to use his Kenyan passport. When he checked out of Kenya, he had to use his Kenyan passport, right? He has additional citizenships. When we go to those countries, he checks in as those countries if he has that passport. So typically the rule is when you're checking in and out of a country, if you have the passport for that country, that's what you must check in and out as. Now, if you go to a neutral country, then you pick the best passport, right? So, for example, let me think of one. Singapore? For Singapore, Kenyans don't need a visa. I think Americans get visa on arrival, right? So I think it's actually better to check into Singapore as a Kenyan than it is as an American in that regard, right? I could be off on that. Keeping them all straight is whatever. But Kenyans can go to Singapore, right? And so that's what happens when you're going to like a third, country. You figure out which one of your passports gives you the best access to the country, and you check in as that. Having multiple passports on you is not a problem as long as they all say the same thing. Okay. I need y'all to have some daggone common sense, right? Just because you moved to Africa and you want to change your name to Kwame Nkrumah, okay, fine, but then do it legally and change all your passports. Don't have a daggone African passport with the name Kwame on it and your U.S. passport says John Smith. You're going to get jammed up, all right? Use your real name or change your name if the spirit so moves you, but then update all your IDs. So as long as all your passports have the same name on them, you're fine. Same name, same date of birth, you're fine. We, believe it or not, we have had people that, and I get it. They wanted to connect to their roots and everything. They didn't mean nothing by it, but you will find yourself in a holding cell with suspicion of being a spy or something with two different passports with two different names on it. But yeah, that's how that should work, right? Division. All right. So I wouldn't worry about it. Yeah, I wouldn't worry about it. Passport portfolios are a thing. Most of our passport portfolio clients are American. We have a couple British ones, but most of them are American. So, even the people in Congress that are bringing these bills, a lot of them have multiple passports, right? They have passports that are considered to be non-issues from a national security standpoint. So, like Mitt Romney's yacht is registered in the Cayman Islands. Remember that when he was running for president, and they were like, "Oh, your boat's even registered in the Cayman Islands. Why isn't it registered in America?" Blah 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 blah. Right? So it's very very possible that Mitt Romney has Grand Cayman citizenship, which you can get by investment. So you just buy a big enough house, they give you a passport, right? And then his yacht was registered in the Grand Cayman Islands, right? So a lot of these folks in the U.S., they have passport portfolios. They have multiple passports that they use to engage with different financial markets around the world as a citizen, and get that benefit. And so they're not, how America works. They're not fitting to, crap on themselves. So it's just going to be one of those things where it's going to be, all right, you're American if you're in America, period. There, you know, you're not anything else for American purposes while in America, and then when you're elsewhere, you know, then you can utilize those other passports. That would be my assumption. This is just a proposal. There's no law. There's no nothing like that. It might not even get that far. So we'll see. But I don't imagine that it's something where you have to renounce. Now, there are countries that do that. Tanzania is one of them. I don't know why anybody would think it'd be worth it to renounce any citizenship to gain Tanzanian citizenship. That they I don't know what their problem is, but Tanzania is one of those where you would have to renounce. Technically, Singapore is too. Singapore, however, they actually have a society that you might want to renounce your citizenship for. Typically, when you have a family office, when we set up a passport portfolio system for somebody, and they have a family office, which means that they essentially own their own investment firm, right? Typically, a member of the family is chosen to sacrifice all of their citizenships and become Singaporean, right? And then the family office is either moved to Singapore or a branch of the family office is opened in Singapore, and that person runs the family office or that branch of the family office as a Singaporean citizen. So the financial incentives to doing that in Singapore are incredible enough where there'll be a member of the family who will essentially fall on the sword for the family and lose their US, UK, Vanuatu, Cook Islands, Nevis, you know, all those citizenships that they worked on over the years to get their passport portfolio going. There'll be someone who falls on the sword and actually gives all of that up to gain the financial incentives of being Singaporean and having a family office there. Right. So if you have a family office in Singapore, and I think there is a certain amount of Singaporean investment, but it's not a lot in the grand scheme of things. Right. If you have a family office, it's not a lot. And so you make that minimum investment and then you're like tax free. Right. So now your family office, right, the vehicle that manages the investments for your family. Right. So all of your assets are under management with this vehicle essentially. Are now the entire thing is tax free, right? So you might have just taken your family from a millionaire family to a billionaire family with that one move. So it's worth it. You know what I mean? A place like Tanzania is just bugging. I don't know what's wrong with them, but when Singapore implements things like that, it's worth it because they're actually giving you financial incentives to do it. There's no incentive in Tanzania to do it, right? So you just have to be strategic about what you're doing. Hopefully that over answered your question. I know I went a little far there. Sorry about that. If I don't know if Veltrix is still here. If you are a client of an agent and you want like this kind of information, you can ask your agent to just let us know. The problem is, since we don't know your situation, like if you're a client of an agent, just think about how you've engaged with us, right? Because you're engaging through your agent and you're your agent's client, you're not ours, right? So just take a breath and think about that, because I see a bunch of you are popping up on all the different live streams right now. So we don't know your situation at all. Like we don't know what you got going on in the US. We don't know, your agent knows all that, like not us. So we don't know what to tell you. Right. So if there's something that you hear on one of these lives and you're like, damn, he never mentioned that before, and you're the client of an agent. If you're not the client of an agent, then we should have already had a discussion because then we know your background, you know, intimately. But if you're the client of an agent and you hear something, you're like, oh man, that really sounds like it could help me. I've never heard that before. Just reach out to your agent and have them, you know, get in touch with us. What do I mean by agent? There are 3 agents that we used to deal with. We've ended the agent contract. So there used to be one agent in Florida. So that's like Income Care Unit and also Properties if you came through them. There was an agent in New Jersey who actually moved to Mexico. So that was Starlight Agency, if you come through them. And then there's one agent who is in Ireland, actually. And that's Emerald Isle Properties, if you come through them. So those agents used to essentially use us as like a vendor, right? So they would have their clients and they would provide strategy for their clients around something, right? So some of them specialize in like rentals, some of them specialize in like relocations or whatever, and then they would come to us and be like, all right, you handle like the legal because you own a law firm, like you handle getting like the permit, right? So like the investor permit or the ordinary residency permit or the digital nomad permit. Do that for my client. Set up a trust fund for my client. Build a house, right? Because we own our own general contractor. So like build the Airbnb for our client. That's the extent of the information we get from an agent. Like, I need you to do this for my client, and because we're going to go do whatever, right? So sometimes they'll like see me on a live, or they'll see like an ad or something from us talking about something like this, like how to pay no taxes when you do business over here and also own a business in the U.S. And they'd be like, "How come you never told me that?" Because you're not my client. Actually, you work with the agent, right? So I don't know. It's not like I'm gatekeeping it from you because you're not my client. It's because I don't know your situation, because your situation might not warrant that information. Not all information is good for you, right? So it depends on what your situation is. And then it's like, oh, okay, well, now that I know what your situation is, here, take this to your CPA and see if, one of these things is good for you or not, right? So that's why we've like gotten rid of the agent thing. And then we had an agent, all the best intentions, the Emerald Isle Agency, actually, the one from Ireland, all the best intentions, right? And so, but we did an Airbnb for somebody. She found some local property manager because the person said they could do it cheaper than like our property manager, which any local is going to tell you that, right? And then the local was just straight stealing from her. So the local was like booking out the place personally when there were no Airbnb bookings and like pocketing the money. They didn't pay for the solar off-grid upgrade in the construction. So if power goes out, the power goes out, right? So they had cameras, but the power would go out, right? And there was no way to like confirm it, right? So then that person was actually just on our live. They had to come to us and engage the law firm, which I can't speak on, specifics of that case, but they had to come to us and engage the law firm to go after that local property manager. And that's as much as I can say about that with the ongoing case. So like, yeah, our prosecution team is doing whatever it needs to do and all of that, but that cost her a lot of money. You know what I mean? And we didn't even know it was happening because she wasn't our client. So her agent set that up. And again, best of intentions, but her agent's not on the ground. Her agent doesn't know what's going on here. Her agent doesn't know the type of games that, locals play. If the person who's paying them isn't here looking over their shoulder, you know what I mean? And so, and then with them not being our client, there's no way for us to like go around our actual client and start giving them advice, especially when we don't know their situation, so that's a formula for us to give them really bad advice because we don't know anything about them, right? So we just got rid of it. Like once that person came in and was like, yeah, I need you to, do whatever I need you to do. We were like, you know what? We're done with the agents. So the agents are still there. They still get paid the same. They just get a referral fee. So they refer us clients, and now those clients are ours. And now we know everything we need to know about them. And then we can make the proper suggestions to them. And then they have access to like all of our specialists. And it might be more expensive, but we're not going to steal from you, right? We're a U.S. company. We can be held accountable under U.S. law. You know what I mean? We have our own law firm. Lawyers can't run away because they have licenses. Like they run away, like for example, we had one a year or two ago where the person like changed their name. Like they changed their name, they got a new ID, and they like gave up their life and like ran to Uganda. You know what I mean? You can do that if you ain't got nothing. right? So if you ain't got nothing, you ain't got nothing to lose, and all of a sudden there's this American paying you U.S. dollars from the United States, you can steal until you get caught, change your name, and bounce. Lawyers can't do that because they have a law license, right? So they can't give up their law license by changing their name and running. You got like, that's their bread and butter. So it's just a matter of like being able to hold things accountable. And then when that client came down from Melindy and was like, look, I'm being stolen from and I want your law firm to handle it, we're like, you know what? We're done with the agents. No more agents. So that's what that is. Right vision. Did that answer your question, brother? Awesome. Yeah, you're most welcome, bro. You're most welcome. Like right now, we were talking about the foreign dividends received deduction, right? Foreign dividends received deduction is a part of the U.S. tax code, and what it states is if you have a C corp, not an LLC, not an S corp, not a nonprofit, a C corp. If you have a C corp and that C corp owns at least 10% of a foreign company, like your company in Kenya, if you're working with us, then the dividends brought from that foreign company into the C corp in America is 100% tax free, right? And so that might be something that makes a great deal of sense to a certain client if they have U.S. businesses and if they want those U.S. businesses to own their overseas businesses, right? It might make sense to that client to know that. But if they don't have U.S. businesses, then it might be cumbersome, right? The filing requirements for that C corp, and all that things might be cumbersome. There also might be something that happens to you on the state level when you open a C corp, right? There might be some tax that you now open yourself up for that exists on the state level. So that has to be taken into account, right? So we don't know what you're really doing. We don't know where your companies are. We don't know what kind of money you're actually making. We don't know where your setup is. We don't know how to actually advise you on those things, right? So it's stuff like that. And typically, and it depends on what kind of business you're coming from. Like typically, if you're doing real estate, it makes more sense to have real estate in an LLC than a C corp from a tax perspective, right? So in that case, you may have to create a C corp umbrella company. You know what I mean? That C corp umbrella company owns a certain percentage of your Kenyan company and your U.S. company, and then you open yourself up for this. It may be based on the money that you're making that the FTC matters, more to you than anything else, right? So the FTC is the foreign tax credit. There's a corporate one and there's a personal one. If you use the foreign dividends received deduction, you typically can't get the foreign tax credit. Now, the foreign dividends received deduction is 100% deduction. Foreign tax credit is typically 90% dollar for dollar, but it's going to depend on what you're making, right? So there's different advice for different folks that makes sense depending on their situation. So if we don't know the situation, we don't know what to tell the folks, is essentially what it boils down to. We have some pretty good professionals on this side though. We have a really solid enrolled agent who specializes in foreign taxes. So he used to work for the government. He left when Trump gave all the government workers the opportunity to just resign and get paid. He took that and actually used it to relocate to Kenya. And so he's an enrolled agent who used to work for the government, not the IRS, but used to work for the government, and is now actually physically located here and helps our U.S. clients navigate the U.S. side of taxes. And then we have tons of KRA agents on this side that help our clients navigate the Kenyan side of taxes. So yeah. Is it better to start a business in Kenya if you're retired in the U.S.? It might be. It might be. Now, if you're living here, then it really might be. But it might be. If you start a business from the U.S. here, the issue with that is you're going to have one or two things that you got to do. You either have to get an investor permit, okay, which might not matter depending on what kind of business you're running. It might be worth it for you to get an investor permit, or you need a local partner to operate the business because you don't have a work permit in Kenya, right? An investor permit is a work permit that allows you to own a business. A work permit you can't actually start a company with. If you have an actual work permit, that means that someone hired you and you work as an employee for that company, right? So if you start a business in Kenya, one or two things have to happen. Either you're just a shareholder and you're not the director, which means you're not the operator, you're not operating the business, and you have a local operator, and then they're sending you dividends, right? So what were we just talking about? Foreign dividends received deduction is 100% tax free, right? So it might be worth it for your C corp to be the shareholder, and then you have a local director that you pay a local salary to, and then those dividends come back to the United States tax free under the foreign dividends received deduction. Now there are caveats to that. You have to hold the dividends for a certain amount of time, right? About a year, in order to get the deduction. So that means your timing has to be right, right? That's why you need professionals, right? So your tax planner has to say, okay, on this day every year is when we throw the lump sum of dividends from last year, right? And then we make sure that those things are held long enough to get the 100% tax exemption. If you send them the day before taxes are due or the day before the year ends, they're still part of last year, and now you got to do taxes this year and you haven't held them long enough. So are you going to get the 100% tax free? Probably not, right? So the planning matters. If you're relocating to Kenya, it still might be beneficial. I see you're saying you're relocating here, which is great, but it still might be beneficial because typically the United States has some of the best debt interest rates on the planet, not just in Kenya, right? So it may be beneficial in the sense that you finance relocating to Kenya through American financing, and that way you still have some options in the form of bankruptcy release. You maybe have corporate bankruptcy restructuring depending on where you took the loans from and all of that. So you have a safety net in case things go left, that you do have the ability to file and discharge debt through bankruptcy, and you're getting a lower interest rate, right? And if things were to change and lower interest rates were to become available here, then there'd be ways for you to refinance out and take something over here. But for now, the world other than China has ridiculous interest rates that they consider to be normal, right? So America typically has really good interest rates. That's one thing that got down. So it might still make sense for you to do that and then be paying the debt with the dividends you're kicking back, tax exempt from Kenya to America. You pay the loan back with those dividends that you're getting tax exempt in the United States, right? So now you're paying the loan back with tax exempt money. The debt itself is tax exempt because it's debt, right? So planning, it's just a matter of planning, right? And then no one can really plan with you unless they really know your situation, number one. And then even the people who know your situation can't do all of the planning because unless they're local specialists. But if they're local specialists, then they're typically not Kenyan specialists. You know what I mean? So that's why you need a team. Right, you need the Kenyan tax specialist, you need the U.S. tax specialist, which we have our enrolled agent, as a certified enrolled agent in the United States. So, and enrolled agents are the only ones who can represent you before the IRS, right? CPAs can't do that. So our enrolled agent is a U.S. certified enrolled agent. We have the equivalent of an enrolled agent on the Kenyan side, so we take care of both of those. We have our corporate strategists on the Kenyan side. We own an entire law firm over here, so we have our whole law firm on the Kenyan side. And then it's just a matter of like you getting with your local people, like your local lawyers or whoever you've used for your corporate strategy and all of that on your side. It's just an issue of getting with them to cover any local laws, any state laws. But if you're relocating, one of the cool things that's available to you is you can create tax domicile in any state that you want. Because the only time that becomes a problem, as I said earlier, is if you're actually operating in another state. So if you're operating in Pennsylvania and you're like, oh, there's no income tax in Alaska, I'm going to tax domicile in Alaska, but I'm legitimately living in Pennsylvania. Now I'm doing tax evasion from Pennsylvania to get the no tax in Alaska. That's the crime, right? But if you've left the country and you legitimately now live in Kenya and you don't live in any of the 50 states, then you don't have a state tax domicile. So if you were to choose a state tax domicile as part of your structuring, as far as like, okay, maybe I'm going to take a W-2 from the C corp, right, to eliminate the C corp tax liability, but I want to do it in a state that has no income tax, right? Now you're not evading anything because you don't actually live in any of those damn states, right? So now, maybe you came from Mississippi or Maryland or whatever, but now you've already removed yourself from that state and you've created domicile in another state that doesn't have income tax that maybe you wouldn't have lived in. But now that becomes your tax domicile, right? So that again is something that you need to speak to your local CPA about and be like, what would it look like if I moved to, if on paper I moved to Delaware, or if on paper I moved to Alaska, but wasn't operating in any of the other 50 states or any other U.S. territory on the state level, right? So I got my federal income taxes. All U.S. citizens got that no matter where they go, right? They typically don't have to pay anything, but they do have to file the tax return. And now what do I do with the state? Right now, if you don't need that, you could just eliminate your state residency and not have residency in any state, but still be a U.S. citizen. So you're not paying any state taxes because you don't have residency, and tax domicile in any state. Now, the last state might try to argue, so you want to make sure that you have proof of that, right? But you having tax domicile, and wherever you move, which typically kicks in 181 days after you've moved there, is definitely a step in the right direction of improving that. It's a lot of incremental things, right? So like I don't renew my Pennsylvania driver's license. Is where I came from, right? I don't renew my Pennsylvania driver's license. I have a Kenyan driver's license, right? Things like that. These are little tiny, incremental things that help prove where your tax domicile is, right? So then if Pennsylvania comes back like, no, you should be paying us taxes. You should be paying us taxes. I can prove I haven't lived there in 6 years, 7 years almost, right? I can prove I didn't renew my voter registration in that state, right? And you can still go to like there's a federal website where you can still register to vote for the federal elections and all of that when you don't do that. But you can prove you didn't renew your voter registration. You can prove you didn't renew your driver's license. You can prove you didn't renew your state ID card, all of those things. And, when you file your tax, like when I file my taxes, my address in Kenya is on my federal tax return, right? For all of those years, right? So, I can prove where my tax domicile is, right? And then here, I don't owe any taxes here at all. Right here, I'm essentially retired. So I don't have taxable income here, right? So it's just a matter of how you structure things, right? Matter of planning, structuring, and a solid team. I saw you say we'll talk soon. Yeah, man. I'm always here. Any other questions on any of that? Any other questions on any of that? Ooh, you're quick. All right. No problem. Yeah, I'll check my email after this. Claudia said that she sent the release. No problem. Yeah. And then we'll send an email to you. Yeah. No problem at all. You're fast, Veltrix. Thanks, Eddie boy. So the major That is such a crazy question. Not that it's a bad question, right? But so, what are the major tax programs that I would tell people to look into? It so depends on your situation. I would say that probably the three major things that you want to research. Number one, foreign earned, foreign earned income exclusion, right? So the foreign earned income exclusion, it's the FEIE. Okay, so go look that up if you're an American. That could exclude, was it 160,000, 130,000? I think it's 130,000 dollars worth of foreign earned income can be excluded from your tax return every year under that. So that helps certain people. There's something called the FTC. There's a corporate FTC and there's a personal FTC. There's also a corporate exclusion and a personal exclusion. The foreign tax credit is essentially if you pay taxes to a foreign, government, then the U.S. will, or may, I shouldn't say will, because there are caveats obviously for all of it, but may deduct the taxes that you paid dollar for dollar. It's now up to 90%. That actually came out of the Big Beautiful Bill. It's the only thing I know of that good that came out of the Big Beautiful Bill, and it's only good for people like us that don't live in America. So it's 90% dollar for dollar, right? So you can kind of choose who you want to pay your tax money to. If you have a problem with something that the U.S. is doing and you're going to owe taxes, you can pay taxes. If you have a tax liability here, you can pay the taxes here first and then get a credit up to 90%. So FTC and FEIE, so foreign earned income exclusion and foreign tax credit are probably number one and number two. And number three would be your foreign dividends received deduction, right? So your FDRD, and that's for businesses. And so that allows you to own a 10% stake or more in a foreign company. And then when that foreign company pays you dividends, those dividends are 100% tax free if you meet the criteria, which one of the criteria is a holding period. So you have to hold those dividends for X amount of days. It's a lot longer for the foreign dividend of received deduction than the domestic, because you can do this domestically as well. So you can just be a US C corp, have to be a C corp, but you can just be a US C corp and then take in the dividends from another US company. And with the same thing, 10% ownership. But when you're local, I believe it's 60 days. Don't hold me to that. Ask your CPA. But I believe it's 60 days or 90 days that you have to hold it for, 100% tax free. For the foreign one, it's like a year. It's a long time. It's way, way longer than it is for domestic. So you really have to have some good planning so that you make the distribution at the right day of the year so that you hold it long enough by the time you file your taxes so that it's 100% tax exempt. So all of this stuff requires you to speak to a local CPA because there are state implications. There are some states that essentially tax you just for having a certain type of corporate structure, right? So like in Jersey, if you took an election from your LLC and you became an S corp, there's an automatic like fee that you had to pay every year. I want to say it was either $300 or $500. But as soon as you took that election, whether you made money or not, there was this fee that you had to pay every year because you took that tax election, right? So there are certain states where, depending on your corporate structure or your business structure, there might be a financial implication to that. So that's why your local person is so important, because like our Kenyan tax professionals wouldn't know that in New Jersey, if you take an S corp election, you got to pay blah 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 blah, right? They also might not know that if you have anyone on your cap table who's not a U.S. citizen or permanent resident, then it'll blow up your S corp election, right? You'll need to be a C corp, right? They also might not know that you can only have 100 shareholders in an S corp, right? And if you have 101, you'll blow up your S corp election, right? So your local person is necessary to make sure that you're in local compliance, right? So you need a team. You got to have a team. All right. So yeah, those are probably the top three. Those are the top three things that I would say, make sure you look at that. Make sure you understand it. Make sure you are talking to someone who understands it and can explain it to you. Don't go to H&R Block. Like, go find a CPA who specializes in what you're doing, or an EA, an enrolled agent. You can also find a lawyer. Typically that's a bit expensive. Typically, but what you will find is you'll find people who are like CPAs and EAs and JDs, right? And so a JD is the Juris Doctorate, which is the law degree. And it's often pedantic, the difference between an attorney and a lawyer. It often doesn't have a meaning in the real world, but sometimes those guys, it's not. So sometimes they do have a JD, but then they went the tax route. So they're a lawyer because they graduated law school, but they're not an attorney slash attorney at law because they never took the bar. So they don't offer legal advice, even though they advertise that they do have a JD, right? Which is fine. But they're a CPA and an EA, so they offer tax advice. And then because they went to law school, it means that they know how to research legal rulings. So that is valuable, right? But they're not necessarily an attorney because they never took the bar. So they're not practicing law, they're practicing taxes, and they have the certifications to legally give tax advice, right? So those folks, even though they have, that law school background, they don't charge the same as lawyers typically. So you can find folks that are JD, CPA, EA, but they're not actually attorneys at law, and maybe pay a little bit more than a CPA, but a lot less than an attorney type of thing. So, but just get somebody who's qualified is essentially what it boils down to. But that's like the only place, in real life where that distinction matters. Most people don't actually make the distinction of like, oh, I'm a lawyer but not an attorney. I'm an attorney, but not a lawyer. That can happen too. A lot of people will say all attorneys are lawyers, but not all lawyers are attorneys. That is not true. In the state of New York and in the state of California, and there is another state, I want to say it's North Dakota maybe, or Montana, there are apprenticeships that can lead to a bar license. So you cannot have gone to law school. You can apprentice under a lawyer for X amount of years. Like in California, you take like a baby bar to make sure that you have the proper requisite, knowledge and blah, 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 blah. And then you take the bar exam. And if you pass, you're now an attorney, but you're not a lawyer. You never graduated law school. So, like I said, typically it doesn't matter. Typically it's a weird kind of pedantic, distinction. But there are the exceptions that prove the rule. You can also operate under lawyer supervision, which I do at times, right? Because just because you own a law firm doesn't mean that you're a lawyer, right? So you can operate under lawyer supervision. So there's all kinds of different levels of like professional and stuff that you can deal with. Just make sure they're a professional. And you might have a really good professional. Oh my gosh. So we had a client, I won't say their name because it's a bit embarrassing, but we had a client that ended up with a $10,000 tax bill because they knew someone who's always done their taxes, and like I guess it was like a friendship or whatever. I don't freaking know. But this person had no idea of what to do with international stuff, right? So whereas these people were probably supposed to get $10,000 back in taxes, they ended up paying $10,000 in taxes because the same old CPA that they use for their local taxes for all those years is the same person they use after they, made their big move into Kenya, which everything they paid for, and it was six figures worth of stuff. They built buildings and all kinds of stuff. All of that stuff was deductible because of the way they did it, right? Legitimately, deductible. And their CPA had no idea how to do that because they didn't have a corporate CPA, and beyond not having a corporate CPA, they definitely didn't have a corporate CPA that understood international, tax complexities. And so they just ran them through like, a Walmart worker, and didn't apply the proper, like they should have had a form 2555, IRS form 2555. Nope, they should have had an IRS form 1116 or 1118. Nope. They probably should have had an IRS form 5471. Nope. So they literally gave the US government $10,000. Now there's, you can correct, you can go back and correct, later, but that's typically a more expensive proposition. And now the government gets a free loan. They get to hold your money for free for, a year or two until you go back and get it. And that was another agent issue. You know what I mean? We didn't know the situation because an agent brought them in, and then they ended up doing their taxes, and then they were here, they moved here, so they saw me, and like, man, if I would have known that I was going to be paying 10 grand in taxes, and then by then it was already too late. They had already paid. So, and I don't even know if they went back and fixed it the next year. We gave them all the information that they needed to do it, but again, that's one of those agent issues. So yeah, man, we're definitely done with the agents, but also make sure that your team is solid. Make sure that your team is solid so that you don't end up in a situation like that where you're paying to the government for nothing. $10,000 is a lot of money, especially here, right? So here, with a lot less money, you can do a lot more. So, like, we have a program where people pay us $75,000, and then over the course of a year, we ladder bonds for them, right? So what they end up with at least 6 million in bonds, paying out at least 11% in interest guaranteed for the next 20 years. Sometimes we do it through their trust, right? So the trust actually owns the bonds, and then if they're the beneficiary of the trust, they get this payout every month. Sometimes it can be a generational wealth trust, so the money might just stay in the trust and take care of their trust estate, right? Which they may or may not have access to. And sometimes they just live off of it. So essentially, that's like your 401k working for you, right? Like when you get to retirement age and you start drawing on your 401k and your Social Security, that's essentially what it's supposed to do. It's supposed to cover all your expenses, right? So what we typically are able to do is, and it depends on the exchange rate and like what's going on in the world at the moment. But we're typically able to, for somewhere between 75 and 85,000, essentially retire you, especially if you're going to live here, right? So you get these payments every month because we laddered. Bonds pay every 6 months, right? So it's a safe investment. It's a treasury bond, not a corporate bond. So it's the government that's paying you back. Every 6 months, they pay you half of the ROI that you're guaranteed. So, for example, the ones that we just bought, I think they were 13%, which is great, right? So 13% for the next 20 years, guaranteed, gets paid every 6 months. So if we buy that bond for somebody in February, typically their payout is January and June, right? The first and the sixth month, right? Because they bought it in the second month, right? So what you do is you get, first and sixth, second and seventh, third and eighth, fourth and ninth. So you need 6 of them in order to get a check every month, right? And so that is sometimes how people finance their lifestyle on their relocation. Is they say, all right, cool, I'm going to build a house. Maybe that's going to cost me, depending on the size of the house, 250,000, all the way down to 170,000. We've even had people do like custom builds where like the house and the land almost cost the same amount. So like they paid like 70,000, but they got like a really small, like they got like a 2 bedroom house. But that was good enough for them. You know what I mean? So like you know whatever. And then they came back and paid another 75 for the bonds. 75, 80, 85, depending on what's going on with the exchange rate in that moment for the bonds. And then the bonds pay their basic lifestyle, right? Because they own their house. There's no, property taxes. They have a well access, so there's no, water. They might have solar, so the solar is paying for the electricity, or they went ahead and bought a diesel generator. A lot of folks will pay that upgrade and get a diesel generator, blah, 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 blah. So they're good, right? Well, now when you're good like that, that's when you start making like serious investments, risky investments if you have that kind of risk tolerance, medium range investments if you don't. But that's when you really start getting into like diversifying and capital preservation and all that. Because no matter what happens, your base is secure, right? That base amount that you want is being kicked out to you every month from the bonds, which would typically have an interest rate above the S&P 500, right? And so that's a strategy that a lot of people, utilize just to make sure that their kind of basic income is covered. And then they can go play and they can see what happens, right? And a lot of people end up winning big because they have the confidence and the freedom to bet big, because they know that their standard, basic income is covered. Does that make sense? What are the annual costs for international tax filings? It does depend. It depends on like if you have a bunch of corporations and like trusts and stuff like that. Typically, I think the average is like 250 for us. Because our average client has like a company themselves and like a generational wealth trust. If that trust is grantor, if the trust is non-grantor, then they don't have to pay for that. But if the trust is grantor, then they do. Well, that's not always true. If the trust is, yeah, no, it is always true. I'm sorry. So, I'm sorry, I was distracted. But if the trust is non-grantor, they don't have to pay for it. If the trust is grantor, then they do. Oh, hey, Tiffy. How's it going? I see you just popped up there. Each one teach one. I see you just popped in there as well. Oh, it looks like TikTok is waking up. How's it going? Everything all right? You enjoying yourself? You're a Tiffy too. All right. So we have a Tiffy on YouTube and a Tiffy on TikTok. All right. But Tiffy on TikTok is one of our agents' clients. How has everything been going? Everything okay? You feeling good, Tiffy? What means? Hopefully, it doesn't mean anything bad. I don't know what that means. Oh, what time is it over there? Is it midnight? That's the one thing with my morning lives. I know it's really late in the U.S. I bet you are sleepy. 10:39. Okay. I sent some stuff through Candace for you to like show your CPA and all that. I hope you got that, and I hope it's helpful. Awesome, 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 awesome. At least that way, like if your CPA is not great with international stuff, at least it gives him the IRC, the Internal Revenue Code, like the law, to go look it up or like ask his colleagues, like, hey, have you guys ever dealt with this? Like, how does it work? Blah 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 blah. So I wanted to give you as much, ammunition as I could to put you in the best position possible to, not pay taxes and make the most money. Hey, how's it going, Lion King? What about? Are you asking about the president, Vance? I don't know what you're saying. Just look at what you wrote. Maybe English isn't your first language. I get it. Run it through Google Translate maybe or something, and put it up again. All right. Yeah, no problem at all. No problem at all. Definitely let us know if they have any questions. Definitely let us know that as well. We have an enrolled agent on this side who's an American. So they're a certified enrolled agent with the IRS, and they could shed some light on things because they specialize in foreign tax. Hey, hey, all is well? Good. What about the Oh, so until you're a citizen, you can't vote. And in some places, so this goes back to don't use vibes to pick the country that you go to. In some places, even after you're a citizen, you can't vote, which is crazy, right? So one of those places is let me think of one of those places that does that. Benin, right? Benin is one of those places where there's a citizenship. It's like a diaspora citizenship, I think, where you can go to Benin, apply for this citizenship. You have to visit Benin once a year. I think it's for at least a week for 3 years. At the end of the 3 years, you get a passport, so you're, a citizen, right? But you can't vote for your entire life, which is weird. Like, you're a citizen, but you have no say in like what your tax rates are. You're a citizen, but you have no say in whether you're taxed on your global income versus the income in the country you're a citizen of. Like, that's a little wonky for me. So yeah, if you're politically, motivated or whatever, you want to be part of that process, that's fine. You just got to become a citizen. But you need to make sure that the country you're becoming a citizen of, it's like real citizenship and not some weird like second class citizenship. That was the same thing with Ghana. A lot of people thought like right of abode was citizenship, which is not. So the right of abode is essentially permanent residency. So again, you have no actual political say in what's happening, and yet you're still taxed, and you still have to live under those rules and under those laws, but you have no method by which to challenge them. So that doesn't work for me. All of these things kind of play out with passport portfolios, like when folks are planning out their path to whatever goal that it is that they want. Things like that will dictate which countries they get a passport for and which countries they don't. And sometimes, you can have enough of an incentive to override, a crappy, deal like that. So, like Singapore, there's enough of an incentive there for you to sacrifice a family member from the passport portfolio perspective and make them just a Singaporean citizen since they don't allow dual citizen and they make you renounce your other citizenships. But there's enough of an incentive there to do that versus like Tanzania trying to get you to renounce your citizenships to get their citizenship and you get nothing with their citizenship. So it's like, what? There's no incentive there for you to renounce every other citizenship you have in order to get a Tanzanian passport that's effectively worthless, right? So you have to judge what you're getting from each. You can get like permanent residence there and maybe shit, but then what they offer you if you have like their golden visa or whatever is enough incentives for you to like stomach that and just, and take it. But if there's not enough in incentives, it just doesn't make sense. And then they're basically banking on a vibe situation. They're basically banking on like, oh yeah, isn't it nice here? Aren't our people friendly? Okay, now take this bad deal and start paying taxes to us. you know. So, oddly enough, some of the countries have these weird bad deals that they're just hoping you go for. Or it's a deterrent, like, or they just don't like want infrastructure, So there's that, I suppose. Right. But wouldn't I still have a tax liability on the Kenyan side? You maybe. So that's another thing, right? We'll have clients that come here and they're hell bent on Nairobi. I don't think you were here for this. I actually covered this, but there's an investment deduction under Kenyan tax law, right? If you're in a major city, the deduction is 100%, which sounds great until you find out that if you're not in a major city, like where I live, the deduction is 150%, which is way better, right? So if you're already doing a foreign dividends received deduction on the U.S. side and getting 100% tax free on the dividends that are sent to your U.S. company, if you can get 150% tax free on the Kenyan side, you're killing it, right? But again, it boils down to, because what they do is they go to Nairobi, and Nairobi's like New York City. It's fabulous, and there's lights, and there's rooftop bars, and there's salsa dancing, and there's all of that, and it becomes a vibe, a feelings over facts situation. It's like, I just love it, I love it. Okay, you love it enough to lose 33%, of your tax bonus, then rock out. You know what I mean? But if you're making a strategic decision, it makes no sense at all, to set up, especially a small operation in Nairobi. At first, you can still go back to Nairobi. Just make your base outside of Nairobi. Make your headquarters outside of Nairobi so that you qualify for that 150% tax free. So it's just strategy. That's all. So yes, eventually, yes, there will be Kenyan taxes eventually, but it doesn't have to start out that way. How long? About 5 years. You can legally probably be tax exempt. Well, not that you're exempt, but you would have no taxable income for about 5 years. Then after that, you're going to start paying corporate taxes. That's only if you got a good team, though. You ain't got a good team, you're going to be paying taxes the first year. So it's only if you got a good team, which might require strategy. So sometimes people, they don't want to pay for strategy, so they just try to like keep records and then pay for someone to file their taxes, like a CPA to file their taxes at the end of the year. But because they didn't have the strategy ahead of time, they screwed up the things that they could have gotten, right? So like, you might be able to get 150% investment deduction, but maybe you only get that if you file your tax quarterly. So because you were like, oh, I'm gonna do my own bookkeeping and and at the end of the year, I'll hire a CPA to save money. Okay, great. Now you hire your CPA and they can't get you the 150% tax deduction because you tried to save a couple pennies. So, that's what it boils down to. Have a solid, strong team, make the investments that you need to make sure that you're getting, and like tell those people like, well, this is what I want. So this is what I'm paying for. If you can't deliver that, then walk away. You know what I mean? And put that in the contract. You know what I mean? Put it in the contract that like, if my goal is to qualify for this, that's going to be one of your deliverables. You're going to deliver, you know, my qualification for this thing, you know, and then you know, what does it take to get to that? You know, and then hold them accountable. If they don't, you know, come through with the deliverables, then you know you should get your money back because they didn't hit the deliverables. You know, or else you could actually hold them accountable because those are certified people, right? They can't just run away. They lose their certifications, they lose their livelihood. So when you have professional teams, they can't just like take off on you, you know. Hey Vaughn, what's going on, man? So does that make sense to everybody? Everybody understand? Everybody picking up what I'm putting down, as my grandpappy used to say? He had all the sayings in the world. I'm gonna put it where the goats can get it. For y'all picking up on all of that? You got it? 1 hour and 45 minutes. This is where I start asking any questions. At that 2 hour mark, I'm getting ready to go have breakfast on the beach. Any questions about any of that? Yeah, man, it'll be you soon. It'll be you soon. I heard that, brother. Planning is great if it's in earnest. There's a lot of talkers, you know. I can tell you're not Eddie. You know, I've been doing this for almost 2 decades, but there's a lot of talkers who just talk, and that's garbage. It's what do they call it? Call it something paralysis. I can't even think of what the name is. They got a cute little name for it, but but essentially you're all talk, you know, and no action. And so you know, but if you're planning in earnest and you're actually like getting stuff done, it's the number one way to do it. 100%. The analysis paralysis, correct. It's the number one way to do it. If you can plan everything out and then execute that plan in earnest, it's amazing. Like we got folks who show up as citizens because they had their residency permit, you know, and they kept their residency permit active the entire time that they were like working towards their retirement in like the U.S. And we're not even talking about being 65. Like we had a guy who was a state trooper, and he was in the military. So he did 20 years in the military. He did I want to say it was 40 years as a trooper. So he was a state trooper. He did his 40 years. No, he did 20 years in the military, 20 years as a trooper. It was 40 years total, but he did them at the same time. That's what it was. So he got into the military at 18, joined the state troopers at 21. Did 20 years in the military, 20 years as a state trooper, almost at the same time. There was like a 2 or 3 year, you know, grievance because you got to be 21 to be a state trooper in his state because you can't carry a handgun at 18, only a rifle, whatever. So he came out of there, you know, in his like, you know, in his like 40s essentially, fully retired, but couldn't tap like Social Security and all of that till you're like 65, right? Right, Eddie. In his last 7 years as a state trooper, he had his residency going here. So he came out with his 7 years of residency done, right? Retired, got his state trooper pension, got his military pension, jumped on a plane, got over here. Our legal team put in his dual citizenship. 6 to 9 months later, he was a dual citizen, had no restrictions. He was a Kenyan citizen with two pensions, a military pension and a Pennsylvania state trooper pension, coming out of the U.S. Maxed out Social Security, because you can do that. You can actually pay off your Social Security, right? Maxed out Social Security, the whole nine. Living lovely, out here. So if you plan and then you execute on the planning, not just talk, those people have the best outcomes, bar none. The best outcomes. Those people typically are millionaires within 2 years of being here. Come here as a thousandaire, like most of us. They're millionaires within 2 years of being here. Yeah, really, 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 really solid. If you plan, really, really solid outcome. All right. Any other questions? Any other questions? If you're writing something, just hit enter, and then you can go back and correct like what you were writing. I'll wait for you. If you want to ask me something, just throw a one in the chat, and I'll wait for you. If not, then it seems like we're wrapping up today. Any questions on any of the platforms? All right, looks like we are good to go. Thanks for hanging out with me as always, and I will be back tomorrow, same time, same place. Um, if you're in the U.S., I apologize that it's always so late for you. But we're working on it. We're gonna figure something out. We're like maybe one day a week or something. It'll be nighttime here, of course, but it'll be relatively early where you are. And then we kind of want to make that count. So it might be a weekend, when the majority of people are not in the office or, whatever the case may be there. So maybe like on a Sunday morning or something, we'll have something worked out. We'll figure it out. Just keep your eye on the channels and you'll get that alert. All right. Thanks for hanging out. Your notes are full. I got you, brother. Thanks for hanging out, and we'll see you tomorrow morning.